This video is designed to help Year 12 accounting students know and understand how to record inventory loss or gain using FIFO. So just a quick recap, inventory loss and gain is important to know about because this can be a really good indicator of things like the amount of theft, the amount of damage that's occurring to your inventory. The way we determine inventory loss and gain under the perpetual inventory system is we perform an inventory count to physically count the amount of inventory on hand, and then we compare that to our inventory cards or records to then see if there's a difference, and if there is a difference, we make an adjustment for inventory loss or gain. Also a quick recap, what are the reasons for inventory loss or gain? There are some really common ones, including theft, damage or breakage, and under or oversupply. So let's have a look at an inventory loss using the FIFO method, and we used the same example for identified cost in terms of the amount of items that were lost. So you can see here, according to FIFO, the earliest inventory on hand is the first inventory that we are going to be losing. So on May 31st, we know that we're going to have an inventory loss, and Memo 81 is going to be our source document. So we can see that for Bond's black V-neck t-shirts, we had 52 items according to our inventory card. 40 of them were $6 per unit, and 12 of them were $7 per unit. The inventory count at the end of the month showed 47 t-shirts. So that means 52 minus 47. That means there is 5 that have been lost. Now they might have been damaged, oversupplied, we're not sure. But we need to adjust for this loss here. So we know that when it's a loss, it's going to be recorded in the out column. And we know that there's going to be 5. But we need to understand, are they $6 units? Are they $7 units? Are they a combination of both? So going back to this rule in the box up here, the earliest inventory on hand is the first inventory to be lost. So what that means is we're assuming that this $6 inventory is going to be the first that is lost. So what that's going to look like is now I have 5 at $6 per unit. I have an inventory loss of $30. I then adjust my two balances here. So I've got 35 units at $6 per unit, and I'm just going to grab my calculator there, is 210, and I've still got 12 of my $7 units, so 84. What does this look like in our general journal? So on May 31, we now have an expense called inventory loss, same as what we did under identified cost, and we're going to be increasing that expense by $30. We then have to reduce our inventory account by 30, and our narration would be something like inventory count revealed inventory loss of 5 units or 5 black t-shirts, whatever we want to say, and then Memo 81. So same process as identified cost, just a different way of calculating the actual inventory loss. So the journal transaction is up here. What's the effect on the accounting equation? It's the same accounts that are affected under identified cost or FIFO. So we know that we've got an expense and we've got an asset. So that means that there is no effect under liabilities. We know that there will be a decrease of $30 for assets, and that's because inventory is going down. And we know that because of the expense going up, means that net profit will go down. There's a decrease in owner's equity, and that's of $30 in this case. So what does an inventory gain look like? So now we have the white crew neck t-shirts. We had, our records are showing that we have 75 items on hand. 35 of them are $6 units, 40 of them are $7 units. At the end of the month, we had 79 units on hand. So you can see that we've got 79 minus 75. We've got 4 that have been gained, and this might be due to things like oversupply by our supplier. So, according to FIFO, inventory gains are recorded at the most recent or the latest amount in the in column. So we need to go through our in column, and we can see that our most recent transaction was on the 15th of May, and we had a credit purchase of items at $7 per unit. So what this means is on May 31st, memo 82, we are now going to have 4 $7 units coming back into our business or being gained. So that's a total of $28 of inventory gain here. So looking at our balance, we still have 35 of the $6 units, so for a total of 210. And now we have 44 of the $7 units for a total of 308. What does this look like in our general journal? So on May 31st, we now have a revenue. So inventory is going to be going up, and we now have inventory gain as our revenue. So inventory is going up 28 in total, and we've also got that non-cash revenue of 28. Same as before for our narration, we're going to have something like inventory count revealed gain of 3 WHT201. I'm using the little code up here, and I'm going to put memo 82 in there. Okay, important that you identify the quantity, and you might identify the particular line if it's affecting one particular line or just in general. So what's the effect on the accounting equation? So we know that inventory is an asset, inventory gain is a revenue. It's the same effect in terms of the accounts as under identified cost. There is no effect on liabilities. We have an increase in assets because inventory is increasing, and we have an increase in owner's equity because when revenues increase, net profit is going to increase, and that's going to be of $30 as well. So the only difference between identified cost and FIFO when it comes to inventory loss and gain is the amount and what value of the units you're going to be using. So it is important to know the differences between the two, and if you want some information on how to compare these differences, have a look at the next video.